There is a quiet change taking place in the banking system, and most people are looking in the wrong direction. They are looking for a dramatic announcement. They are waiting for a crash. They are waiting for a politician to stand at a podium and say, your money is no longer as free as you think it is. That is not how these things usually happen. In my experience, the most important shifts in money and power often happen gradually through rules, incentives, legal language, compliance systems, and risk controls that most ordinary people never read. By the time people notice them, the system has already changed. That is what I believe is happening now with banking. I do not say this to create fear. Fear is usually a bad decision maker. Fear makes people overreact. Fear makes them sell at the wrong time, move money carelessly, or trust the wrong people. But ignorance is even more dangerous. When you do not understand the rules of the system you are operating inside, you are not really free. You are simply trusting that the system will treat you fairly when stress appears. And history has taught me many times that systems do not behave kindly under stress. They behave according to rules, incentives, and self-preservation. That is why I want to walk through the banking changes that concern wealthy families, retirees, business owners, and anyone who has meaningful savings inside the financial system. The important point is not that banks are evil. The important point is that banks are part of a larger machine. They are regulated, pressured, monitored, and incentivized to protect themselves first. When stress rises, the rules of the machine become much more important than your personal relationship with your banker. If you understand those rules, you can protect yourself calmly. If you do not understand them, you may discover too late that access to money and ownership of money are not always the same thing. The first thing to understand is the difference between a bailout and a bail. For most of the last century, people assumed that if a major bank got into trouble, the government would step in and rescue it. That was the model many people saw during previous crises. The bank failed. Taxpayers absorbed part of the cost, and the system continued. After the 2008 financial crisis, regulators looked at that model and decided it created a political and financial problem. Governments had spent enormous amounts of money stabilizing banks, and the public became angry. Taxpayers did not want to be used again as the first line of defense for bank losses, so the system began to move toward a different model. Instead of a bailout from the outside, the system began to create a bail from the inside. That sounds like a technical distinction, but it is very important in a bail. When a bank becomes insolvent or faces severe losses, regulators can use parts of the bank's own balance sheet to stabilize it. The losses move through a hierarchy. Shareholders are hit first, then certain debt holders and bondholders can be hit. And in extreme cases, large uninsured depositors can become part of the loss-absorbing structure. Most people do not think of themselves as creditors to their bank. They think, I deposited my money, so the bank is holding it for me. But legally and economically, a deposit is more complicated than that. When you deposit money in a bank, you are lending money to the bank. The bank owes it back to you, subject to the rules of the system. Deposit insurance protects part of that relationship, but only up to a limit. In the United States, the standard insurance limit is $250,000 per depositor, per insured bank, per ownership category. In other places, the limits are different. In the European Union, it is generally 100,000 euros. In the United Kingdom, it is 85,000 pounds. In Canada, it is 100,000 dollars Canadian for many protected categories. Everything above the insured limit should be treated differently in your mind. It may feel like cash. It may appear as cash on your screen. But in a banking crisis, uninsured deposits can become exposed to the credit risk of the bank. This is why sophisticated families pay attention to where deposits sit, how they are titled, and whether money is spread across institutions. It is not because they believe every bank is about to fail. It is because they understand that the purpose of planning is to be prepared before probabilities become emergencies. A system can look stable for years and then reprice risk in days. That is the nature of banking. Banking is built on confidence. Confidence is built on the belief that everyone can access money when they need it. But no banking system can satisfy all depositors demanding all money at the same time. That is why the rules matter. That is why insured limits matter. That is why concentration matters. The person who keeps all of his liquid wealth above the insured limit in one institution is not just making a convenience decision. He is making a risk decision, whether he knows it or not. The next thing most people do not think about is dormant accounts. This rule sounds harmless because the word dormant sounds harmless. It makes you think of forgotten accounts, lost passbooks, money nobody is using. But the principle matters. In many countries, if an account sits inactive for long enough, it can be legally classified as dormant. Once that happens, unclaimed asset laws or escheatment rules can allow the state to take custody of the money. In many cases, the owner can later reclaim it, but the process can be slow, bureaucratic, and frustrating. The real issue is not just that dormant account laws exist. The issue is that the time periods and asset categories can change. In some places, the period before an account is treated as dormant can be only 3 to 5 years. In others, it can be longer. Some countries have expanded dormant asset schemes beyond simple bank accounts into investments, insurance balances, and other forms of financial property. If you are young, active, and checking all accounts every month, this may not seem important, but if you are older, if you have accounts in multiple places, if you have moved countries, if you have inherited assets, or if your family does not have a clear map of where everything is held, this can become a real problem. A forgotten account can stop being merely forgotten. It can enter a legal process. That is why asset mapping matters. You should know where your money is, how it is titled, who has authority to act if you cannot, and what activity is required to keep an account alive. This is not exciting work. It does not feel like investing. It does not feel like making money. But the wealthy understand that preserving money requires administrative discipline. Money is not protected only by returns. It is protected by systems. A portfolio without records is fragile. A bank account nobody knows about is fragile. An overseas account without documentation is fragile. An insurance policy that heirs cannot find is fragile in life. Fragility often hides in boring places. The next rule is much more serious because it touches the line between criminal enforcement and ordinary financial life. Most people assume that assets can only be taken after someone is convicted of a crime. They believe the sequence is simple. A person commits a crime. The government proves it. A court convicts him. Then assets connected to that crime are seized. That is not always how the real world works. Many developed countries have legal systems that allow authorities to freeze or seize assets before a criminal conviction. In the United States, this is often discussed under civil asset forfeiture. In the United Kingdom, there are tools such as unexplained wealth orders. Other countries have related mechanisms designed to deal with proceeds of crime, corruption, money laundering, or tax evasion. The stated purpose is understandable. Governments want to stop criminals from hiding money. They want to prevent illicit funds from moving through legitimate banks. But every enforcement tool creates a risk of overreach. When the legal threshold for freezing assets is lower than the threshold for proving guilt, innocent people can be forced into a defensive position. Their money can be frozen while an investigation proceeds. Their accounts can become inaccessible. Their cost of legal defense can rise quickly. And the burden of proving the legitimacy of funds can become heavy. For a wealthy family, this can be inconvenient and expensive. For a small business or retiree, it can be devastating. That is why documentation is not optional. If you cannot explain where money came from, why it moved, who received it, and what the purpose was, you are relying on someone else's interpretation of your financial behavior. I have learned not to rely on interpretation when the stakes are high. A clean paper trail changes the situation. It does not guarantee that you will never face a freeze, an inquiry, or a review, but it changes your ability to respond. It turns a suspicious pattern into an explainable pattern. And in the modern banking system, explainable is powerful. Then there is the risk of capital controls. Many people in developed countries think capital controls are something that only happens somewhere else. They imagine countries with unstable currencies, weak institutions, or desperate governments. History says otherwise. Capital controls have appeared in developed economies under stress. During the Cyprus banking crisis, withdrawal limits and transfer restrictions were imposed. During the Greek debt crisis, cash withdrawals were capped after Iceland's banking collapse. Capital controls lasted for years. The pattern is always similar. When a country faces severe financial stress, the government tries to stop money from leaving. It may limit withdrawals. It may restrict foreign transfers. It may block or delay currency conversions. It may make it difficult for citizens to move funds outside the domestic banking system. Technically, your money may still exist. Practically, access can become constrained. This distinction matters. A balance on a screen is not the same as usable money. Liquidity is not only about the value of an asset, it is about your ability to move it when you need to move it. If restrictions are imposed after stress begins, it may be too late to diversify. That is why people who think in systems prefer to build optionality before they need it. Optionality means having more than one bank, more than one jurisdiction, more than one currency exposure, and more than one path to liquidity. This does not mean you should panic or move all of your money abroad. That would be another form of extremism. And extremism usually creates new risks. It means you should understand the principle. A single point of failure is fragile. A person who has all money in one bank, one country, one currency, and one access channel may feel simple and efficient during normal times. During a crisis, that simplicity can become a trap. The next issue is not a banking crisis. It is the growing tendency of governments to shape what people are allowed to hold. This appears in many forms. Some countries have complicated tax rules for foreign investments. Some regulators scrutinize cryptocurrency holdings. Some rules affect stablecoins, foreign currency accounts, gold transactions, and offshore funds. Sometimes the stated purpose is financial stability. Sometimes it is anti-money laundering. Sometimes it is tax compliance. Sometimes it is consumer protection. Those justifications may be sincere. But the practical result is that the range of financial choices available to individuals can narrow. The more governments worry about capital flight, tax leakage, currency instability, or financial crime, the more they tend to monitor, restrict, or discourage certain asset choices. This is a very important principle. The freedom to own something is not the same as the freedom to move it, sell it, transfer it, or hold it without penalty. A person may say, "I own my money." But the real question is, under what conditions can you use it? Can you transfer it internationally? Can you convert it to another currency? Can you buy foreign assets? Can you hold digital assets? Can you hold physical gold? Can you sell an investment without triggering punitive reporting rules? Can you access the account if your profile suddenly becomes inconvenient to the bank? Ownership is not one thing, it is a bundle of rights. When the bundle becomes smaller, your economic freedom becomes smaller. The next risk is currency debasement, and it is one of the quietest forms of loss. People worry about money being trapped, frozen, or seized because those events are visible. They are sudden, they feel like an attack. Currency debasement is different. It is slow. It happens through inflation, monetary expansion, and the decline of purchasing power. Your account balance may stay the same or even rise. But the money buys less. The loss is hidden inside prices. If inflation exceeds the interest you earn on deposits, your savings are losing real value. This is not a theory, it is the arithmetic of money. When central banks expand the money supply faster than the economy grows, purchasing power eventually adjusts. It may not happen immediately. It may show up in asset prices first, then consumer prices, then wages, then political tension. But over long periods, debasement is one of the great forces that transfers wealth from savers to those who own productive assets. This is why I do not think of cash as safe in an absolute sense. Cash is safe for liquidity. It is useful for optionality. It helps you avoid forced selling. It gives you the ability to act during panic. But cash is not safe as a long-term store of purchasing power if the currency is being debased. This becomes even more complex as central banks explore digital currencies. Central bank digital currencies are still debated in many places. They are not all the same, and it would be wrong to assume every version will be used in the most restrictive possible way. But the concept itself changes the range of tools governments might have in the future. Digital central bank money could, depending on design, make it easier to impose negative interest rates, targeted stimulus, spending restrictions, demographic-based transfers, or more direct visibility into transactions. Again, the point is not to panic. The point is to understand that the architecture of money is changing. When the architecture changes, the rules of behavior can change. A paper note in your hand, a bank deposit, a payment app balance, a stablecoin, a brokerage account, and a central bank digital currency are all different forms of financial claims. They do not carry the same rights, the same privacy, the same counterparty risk, or the same restrictions. If you treat them as identical, you miss the most important part of the system. Then there is the power of tax authorities. Every developed country gives tax agencies mechanisms to collect unpaid taxes. In many cases, those mechanisms include the ability to freeze accounts, levy assets, or demand information. Through international agreements and information sharing systems, tax authorities can also reach across borders more easily than they could in the past. This is not about avoiding taxes. Avoiding legal obligations is not a good strategy. It creates compounding risk. But even people who file properly and pay what they owe can be concerned about aggressive enforcement, especially when they have international accounts, multiple entities, complex income streams, or assets in different jurisdictions, the concern is not merely whether you are right. The concern is how long and how expensive it may be to prove that you are right. A person who has all liquidity in one account can be pressured very quickly if that account is frozen. A person with clean records, tax filings, professional advice, and diversified banking relationships is in a stronger position. Systems matter, documentation matters, jurisdiction matters. The next change is something almost everyone has experienced, even if they do not recognize it. Every bank now operates under strict anti-money laundering and compliance rules. They monitor transactions, they look for unusual patterns, they file reports, they ask questions, they delay transfers, they sometimes freeze accounts while compliance departments review activity. This monitoring is not new. What is changing is its speed, scale, automation, and the amount of data being shared. Banks increasingly use behavioral monitoring and AI-driven risk assessments. A transaction does not have to cross a famous threshold to be noticed. The old idea that anything below a certain number is invisible is wrong. The modern system is not simply threshold-based, it is pattern-based. If you send large transfers, receive foreign wires, withdraw significant cash, use cryptocurrency platforms, move money between countries, or operate outside the average customer profile, you can trigger reviews even when everything you are doing is legal. The problem is that compliance systems are built to reduce the bank's risk, not to optimize your convenience. If a bank approves a transaction that later becomes part of a fraud or money laundering case, the bank can face fines, regulatory pressure, and reputational damage. If the bank delays your legitimate transfer for a few days, you are inconvenienced, but the bank's downside is usually limited. So the incentive is predictable. When in doubt, slow it down. This is why wealthy clients often choose banks that understand their profile. A person who frequently sends international wires should not be banking with an institution that treats every international wire as strange. A person with complex business flows should not rely on a bank designed only for simple payroll deposits and mortgage payments. A person with large liquidity needs should not assume that a small local branch will always process unusual transfers quickly. Fit matters. A good banking relationship is not just about fees or interest rates. It is about whether the institution understands the type of financial life you actually have. There is also the issue of de-risking. This is when banks close accounts, not because the client has done something illegal, but because the bank decides the client's profile creates too much compliance risk. The customer may be involved in cryptocurrency. The customer may send large international transfers. The customer may be connected to a politically sensitive country. The customer may be a politically exposed person. The customer may operate in a business category that creates extra monitoring obligations from the bank's perspective. Closing the account can be easier than investigating deeply. From the customer's perspective, this can feel absurd and unfair. You can be doing everything legally and still lose access to a banking relationship because the bank does not want the risk of serving you. This is another example of a broader principle. Financial access is becoming more conditional. You may have money, you may have legal income, you may have documents, but if your profile does not fit the bank's risk appetite, the bank may decide not to serve you. That is why redundancy matters. A single banking relationship is a vulnerability. Multiple relationships with institutions that understand your needs create resilience. The final change is the restriction of physical cash. This is happening most visibly in parts of Europe where limits on cash payments have become more common. Some countries restrict large cash transactions by law. In other places, cash becomes harder to use because merchants, banks, insurers, and payment processors discourage it or refuse it. This is a major shift because cash has historically represented a certain kind of freedom. It is immediate, it is private, it settles without a bank app. It does not require permission from a payment network in the moment of exchange. But cash is also difficult for governments to monitor, which is why policymakers often dislike it. The trend is clear in many places. More payments are digital. More transactions leave records. More systems depend on intermediaries. That creates convenience, but it also creates dependence. When money becomes fully intermediated, access to the payment system becomes access to economic life. If you cannot use the system, you can be effectively excluded. I am not arguing that people should reject digital payments. That would be unrealistic and unnecessary. Digital systems are efficient, they are useful, they are part of modern life, but I do believe people should understand the trade-off. Convenience often reduces friction. but sometimes friction is a form of protection. A world with no cash, no privacy, no alternative payment rails, and no banking redundancy is a world where every financial action depends on permission from systems you do not control. That is not a reason to panic, it is a reason to design better. So what does a more resilient banking strategy look like? It begins with the recognition that the goal is not to escape the system. Most people cannot and should not try to live outside the financial system. The goal is to avoid being trapped by any single part of it. You want enough money in the banking system to function normally, pay bills, receive income, and maintain liquidity. You want enough diversification across institutions, so one bank problem does not become your personal crisis. You want to stay within insured limits where practical, or at least understand when you are above them. You want clean records that explain the origin, purpose, and movement of significant funds. You want accounts that remain active, mapped, and known to the people who may need to help you. You want professional advice when tax, cross-border, estate, or business issues become complex. You want to understand the difference between cash for liquidity and assets for long-term purchasing power. You want to avoid unnecessary patterns that make ordinary behavior look suspicious. You want redundancy before stress appears. That is how I think about this. A person who waits for a banking crisis to build a banking plan is already late. A person who waits for capital controls to diversify jurisdictions is late. A person who waits for a frozen account to organize documentation is late. A person who waits for a bank to close an account before building a second relationship is late. The best time to build resilience is when everything still works. That is true in investing. It is true in geopolitics. It is true in life. I have seen this pattern many times. People assume stability is permanent because stability is what they have recently experienced. Then a shock comes. The rules that seem theoretical suddenly become practical. The forms, limits, disclosures freezes, and compliance departments become real. The prepared person experiences inconvenience. The unprepared person experiences crisis. There is a very big difference between the two. I want to be precise about what I am not saying. I am not saying your bank will fail tomorrow. I am not saying every government will impose capital controls. I am not saying every central bank digital currency will be used to control spending. I am not saying you should remove all money from banks or make dramatic moves based on fear. That would be bad thinking. Good thinking is probabilistic. It asks what can happen, what the consequences would be, what the cost of preparation is, and what actions improve resilience without creating new unnecessary risks. In this case, the cost of preparation is often low. Review your insured limits, keep accounts active, maintain records, build more than one banking relationship, understand the rules around large transfers. Think carefully about where liquid assets sit, make sure your family knows where accounts are. Use professional guidance when crossing borders or dealing with complex tax matters. These are simple actions, but simple actions done early can prevent complex problems later. The people who get hurt in systems are often not the people who took too much risk knowingly. Many times they are the people who never realized they were taking risk at all. They thought money in a bank was just money in a bank. They thought an inactive account would wait forever. They thought a legal transaction would never be questioned. They thought an account could not be frozen unless they did something wrong. They thought capital controls could never happen in a developed country. They thought cash would always be accepted. They thought a bank would always want them as a customer if they had money. Those assumptions are not always true. The modern financial system is becoming more monitored, more regulated, more automated, and more conditional. That does not mean it is collapsing. It means the rules of operating inside it are changing. When rules change, behavior must adapt. This is one of the biggest lessons I have learned from studying history and markets. People lose when they mistake the world they grew up in for the world that still exists. The old banking world was simpler. You opened an account, deposited money, wrote checks, withdrew cash, and expected the bank to act as a neutral place to store value. The new banking world is different. The bank is a regulated node in a global compliance network. It is a data collector, it is a risk manager, it is an enforcement partner, it is a business with its own survival incentives, it is part of national and international systems of reporting, monitoring, and control. That reality may feel uncomfortable. But seeing reality clearly is always better than denying it. If you are wealthy, retired, international, entrepreneurial, politically exposed, crypto-involved, cash-heavy, or simply someone with large balances, this matters more to you than to the average person. The system does not treat every profile the same. It looks at patterns, it looks at jurisdictions, it looks at industries, it looks at counterparties, it looks at account behavior, it looks at how much of your activity fits what the bank expects. Your job is not to become paranoid. Your job is to become legible, make your legitimate financial life easy to understand, make your accounts resilient. Make your documentation clean, make your liquidity diversified, make your family aware, make your decisions before pressure arrives. That is how you protect money in a world where money is no longer just paper or numbers, but part of a complex set of rules. At the end of the day, the most important thing is control, not the illusion of control that comes from staring at account balances. Real control means knowing where your money is, what claims you have, what limits apply, what happens under stress, who can act on your behalf, how quickly funds can move, what documentation supports them, and what alternatives exist. If one channel closes, that is the kind of control that matters. The banking system is not designed around your personal peace of mind. It is designed around stability, compliance, risk management, and institutional survival. So you must design your own financial life around resilience. You do not need to be extreme. You need to be prepared. You do not need to fear the rules. You need to understand them. You do not need to abandon banks. You need to stop assuming one bank, one account, one currency, one jurisdiction, and one access point is enough, because in the world we are moving into, the biggest risk may not be that your money disappears. The bigger risk may be that your money is still there, but you cannot use it when you need it most. And that is why the time to think about this is not during a crisis. It is now.